You are looking at the exact visualization Wall Street uses to terrify retail investors behind closed doors. It is called the Lost Decade. It is the historical chart of the S&P 500 screaming that a catastrophic correction is imminent. You see the headlines about the market breaking all-time highs every other week, but right underneath that, every financial talking head is warning you that the bubble is about to burst. So what do? You sit on a pile of cash. You want to invest, but you are completely paralyzed by the fear that if you deploy your money today, you are buying the absolute peak. You want to wait for the inevitable crash so you can finally buy in cheap and be the smart money for once. But here's the uncomfortable mathematical truth. Waiting for the perfect crash to invest your money is statistically the most expensive mistake you will ever make. Let us look at the terrifying math driving this panic. There is a major indicator called the Shiller PE ratio, and right now it is pushing dangerously close to 40. That sounds complicated, but simply put, it means the stock market is priced for absolute flawless perfection, and historically, investors are paying double the normal price for a single dollar of corporate earnings. Out of the entire history of the U.S. stock market, only 2% of valuations have ever been higher than today. The last time we saw this specific, terrifying shade of red was the absolute peak of the year 2000 tech bubble. And after that peak, it took 15 years for the stock market to recover its real dollar purchasing power, a literal lost decade and a half. When you hear that data, your immediate survival instinct is to fall straight into what Wall Street insiders call the cash trap. That sounds complicated, but simply put, it means you were lured into the false security of a high-yield savings account, completely blind to the silent taxes and lost opportunities draining your wealth. Holding your money in a bank account paying 5% feels like a genius move. Wall Street loves it when you do this. But let's do the math on that 5%.
First, the IRS taxes your bank interest as ordinary income, instantly shaving your return down to maybe 3.5%. Then inflation quietly eats another 3% of your purchasing power. Your real inflation-adjusted after-tax return is practically zero. Meanwhile, as you sit in cash waiting for the sky to fall, the market continues to run. You are missing out on corporate dividends. Those dividends automatically reinvest, buying you fractional shares that compound over time. The opportunity cost of sitting on the sidelines for 2 years waiting for a crash often eclipses the actual damage of the crash itself. Let us bring this down to earth with a real-world case study. Look at Dave. Back in 2018, Dave thought the housing market was slightly overvalued, so he sold his house, rented an apartment, and hoarded cash in the bank. He sat there smugly waiting for the housing bubble to pop, convinced he was playing 3D chess against the system. But the market kept running. Then 2020 happened and prices exploded. By the time Dave realized the apocalyptic crash was not coming on his personal schedule, that exact same house cost 50% more, and mortgage rates had doubled. He tried to be a financial genius, and he permanently priced his own family out of the neighborhood. The stock market works the exact same way. When you pull your money out of your 401k to sit in cash, you are trading a potential temporary drop in the market for a guaranteed permanent loss to inflation. So why is the market so historically expensive right now? You keep hearing financial talking heads throw around buzzwords like the Magnificent Seven or the AI supercycle. They market this stuff on an endless loop, acting as if they have magically reinvented gravity and the old rules of finance no longer apply. It is incredibly frustrating to watch Wall Street sell this fantasy. But before you panic and freeze your retirement contributions, you need to understand a massive structural secret hiding behind the panic. It is called the denominator problem. That sounds complicated, but simply put, it means the massive price tags of just a few giant tech monopolies are artificially distorting how expensive the entire market looks. Let us look at the actual data. The standard S&P 500 is what we call market cap weighted. That means the bigger the company, the more space it takes up in the index. Because companies like Apple, Microsoft, and Nvidia have swelled to multi-trillion-dollar valuations, they are dragging the price-to-earnings ratio of the entire index into the stratosphere.
Imagine a perfectly balanced barbell with 500 heavy weights. Now, someone straps industrial rocket boosters to just 7 of those weights on one end. The entire barbell violently tilts. But what happens if you strip away that distortion? Enter the equal weight S&P 500. This is an index where all 500 companies get the exact same slice of the pie, no rocket boosters. When you look at the valuation of the equal weight index, the terrifying, historically massive bubble completely vanishes. The other 493 companies in healthcare, industrials, and retail are actually chugging along at perfectly reasonable normal prices. They are just completely hidden beneath the massive shadow of big tech. So, is it 1999 all over again? Yes and no. Back in 1999, companies with zero revenue slapped .com on their name and were valued at billions. They were selling pure fantasy. Today, the tech giants driving this valuation are actual cash-printing machines holding up the infrastructure of the entire internet. But the rubber band is still stretched dangerously tight. If we look at the math, dropping a massive lump sum of cash into a historically overvalued market can be brutal. Let us look at a high-stakes simulation from the absolute peak of the year 2000 bubble. Imagine two investors, Investor A and Investor B. Both have $120,000 to invest in January of the year 2000. The market is at absolute peak delusion. Investor A lump sums all $120,000 into the market on day one. The very next month, the bubble bursts and the market collapses. Investor A watches their life savings get completely vaporized. It takes them 15 agonizing years of pure stress just to see their account balance recover to their original starting amount. Now look at Investor B. Investor B refuses to time the market. Instead, they use dollar cost averaging. They break that same money up, automatically investing exactly $1,000 a month, every single month for 10 straight years. During the crash of 2001 and 2002, Investor B does not panic because their money is now buying shares at a massive discount. When the market is down 40%, their monthly $1,000 aggressively vacuums up almost twice as many shares as it did at the peak. When the market recovers in 2003, Investor B's portfolio explodes. By the time Investor A breaks even 15 years later, Investor B has effectively doubled their wealth. They both invested the exact same amount of money and lived through the exact same terrifying market crash. The only difference was that Investor B used automation to turn a catastrophic collapse into a mathematical advantage. When you hear that, your brain immediately screams, then why would I invest a single dollar right now if prices might drop? Let us use a grocery store analogy to explain cost basis. That sounds complicated, but simply put, it means your true price is the average of everything you bought over time, not the terrifying peak price you saw on day one. Imagine you are buying premium organic eggs to feed your family. On week 1, the market goes crazy and eggs cost $10 a carton. You spend $50 and get 5 cartons. It feels terrible. But on week 2, the egg market crashes. The price drops to $5 a carton. Because you are dollar cost averaging, you spend your strict $50 budget again. This time, that same $50 buys you 10 cartons. You have spent $100 total and you have 15 cartons of eggs. Your actual mathematical cost per carton is now $6.66. You never paid the horrific $10 price tag for your entire supply. You blended your risk. Apply this exact same logic to your portfolio to survive an overvalued market. First, swap brand versus generic. If big tech is wildly overpriced, allocate some investments into cheaper substitutes. Buy that equal weight S&P 500 index fund or mid-cap value funds trading at completely boring generic valuations. Second, change your purchase timing. Instead of buying a massive bulk order of stocks when prices are at all-time highs, just buy exactly what you need every single Thursday when your paycheck hits. Third, make budget line item changes. Cancel the subscription garbage you do not use and redirect those exact dollars into buying income-producing assets. You do not stop eating and you do not stop investing. This brings us to your ultimate mathematical weapon against an overvalued, irrational stock market: dollar cost averaging. You set up your accounts to automatically buy a fixed dollar amount of an investment on a regular schedule, completely ignoring what the price is doing. If the stock costs $100, your $500 buys 5 shares. If the market collapses to $50, that exact same $500 automatically buys 10 shares. You are not avoiding the crash, you are weaponizing the crash. When the market is expensive, you slowly build your base. When the market violently corrects, your fixed monthly contribution vacuums up equity at a massive discount. When the market eventually recovers, those cheap shares absolutely explode in value. You just neutralized the top. You bypassed the lost decade entirely by blending your purchase price across the entire economic cycle. But how do you actually execute this without losing your mind during the next market panic? You have to build a psychological firewall. Human beings are biologically wired to run away from danger. When you see your portfolio bleeding red, every survival instinct will scream at you to stop buying. You cannot rely on sheer willpower to hit the buy button during a crash. Your emotions will betray you. So you have to automate the impossible. Here is your exact, non-negotiable 5-minute setup checklist to guarantee you survive the next crash. Step 1. Log into your brokerage or employer 401k portal today. Step 2. Find the setting labeled Recurring Investments or Auto Invest. Step 3. Tie the automatic transfer date to the exact morning your paycheck hits your checking account. The money must vanish into your investment account before you even have a chance to feel it, spend it, or worry about it. Step 4. Select a broad market index fund or an equal weight fund, set the dollar amount, and hit confirm. Step 5. Turn off every single portfolio notification on your phone. Delete the investing app from your home screen if you have to. You are literally building a firewall between your money and your own human panic. The financial media wants you glued to their screens, terrified of every minor dip, because your fear generates their ad revenue. They use buzzwords to make you feel like you are not smart enough to manage your own money. They want you to think investing is about perfectly dodging the storm. It is not. The data clearly shows that the market can remain overvalued for years longer than you can remain solvent sitting in cash. Investing at high historical valuations is not fun. Nobody likes paying a premium for an asset, but it is mathematically superior to sitting on the sidelines watching inflation quietly consume your life savings. Stop waiting for the perfect moment. The perfect moment does not exist. Stop trying to find the absolute bottom of the market because nobody rings a bell when we get there. Why does all of this actually matter? Because your ultimate goal is not to beat the Wall Street algorithms or to win an argument in the comments section about PE ratios. Your goal is to buy your life back. The whole point of front-loading your investments is to hit a critical mass where your money makes more money than your day job. You want to reach a point where you can downshift, take a breath, and coast into true financial independence. You absolutely cannot reach that freedom if you are paralyzed in cash. For the automated investor, a market crash is not a tragedy, it is an accelerator. It is the exact mathematical mechanism that puts your retirement on fast forward. So take a deep breath. Stop checking the daily news feeds. Build your 5-minute firewall today. Stop trying to outsmart the math and start letting the math work for you. Set your automation, buy the broad market, ignore the noise, and go live your actual life.